My name is Alexis Rogers, and I'm the Customer Relationship Lead here at RightCapital. And I want to say thank you again for joining us for a continuation of RightCapital Academy, our Back to Basics refresher on cash management methods. So today, as the name entails, we are going to be reviewing various ways to show investing cash that clients have on hand, especially when you have scenarios of maybe clients having a lot invested in cash in this particular market. Maybe they were nervous and didn't want to invest it yet. If you want to illustrate the impacts of investing that cash, then this is the webinar for you, as we're going to be reviewing some of that fun stuff today. And so today we're going to be reviewing all the different cash management methods and what the nuances of each of them are and which ones you want to select depending upon what you want to model in the system. We're also going to go over how to include bank accounts and asset allocation, especially when you're trying to illustrate that a client might be invested heavily in cash. This can be helpful to have a nice visual backdrop for when you're having that conversation with a client. We're also going to be reviewing, of course, illustrating scenarios of investing cash that clients have on hand. And we're also going to be looking at some of those key comparison visuals to assist in those conversations with clients when we're trying to show the impacts of truly investing some of that surplus of cash. And of course, this is intended to be an interactive webinar. So if you have any questions, please feel free to navigate to that questions dropdown, and I'll be sure to answer any questions you might have. And so switching gears into RightCapital, today we are going to be reviewing the Gilmore family plan. Just some background about the Gilmores. They currently are in their mid-50s. They have 2 children. They have a current net worth of $2.4 million, including a property that they have, their primary home. Another thing to note is that they do have a large amount in the bank. They had a sale of property prior to, us seeing them. And so we're going to be having that conversation today with the Gilmores of what it looks like to potentially invest some of this large amount that they have in cash on hand. And so this is some background about what the Gilmore's family plan looks like today. They have some decent salary and savings that they're making and some decent living expenses as well. Moving on to the main portion that we want to consider when we are looking at modeling different ways of investing cash on hand is going to be those cash management methods that we can elect. This can be found in the gear icon in the upper right-hand corner under settings. And then here in methodology, this is where we can control the foundations for our settings in RightCapital and for the foundations for this financial plan for just the Gilmore family plan. One thing to note is that when we are in an individual client plan like we are right now, and we're under the gear icon settings methodology section, we are only changing the settings for this particular client plan. This change that we're making here is not going to impact any other clients. So to change the Gilmore's cash management method, we're going to find that located on the right-hand side of this list, and it's going to be the 3rd option down. And so here's where we control what we're using for our cash management method. Right now, the option that I have selected is to treat bank account as cash, spend cash before taxable. What this means is that the balance that we have in the bank accounts currently is going to grow naturally at cash rates of return, and that cash, when we have a negative net flow, for example, so if our income inflows are lesser than our outflows or expenses for that year, the system knows that we're going to have to tap into assets to fund those outflows. The system will pull from the taxable accounts first, and then tax deferred assets, and then tax free if all else gets depleted. This cash management plays a role in that you can indicate that you want to spend cash before the taxable brokerage account. So with the treat bank account as cash, spend cash before taxable, we are indicating that we are ensuring that the bank accounts, what we have listed there, is just being treated as bank accounts and earning cash rates of return, and it will be spent before the taxable account. But if we select this drop down, we do have the option to specify that we want to treat bank accounts as cash and then spend cash after taxable brokerage. So that is another option. It's also going to treat the bank account as just growing at cash rates of return. and it's going to be spent after we spend down the taxable brokerage bucket. One thing to note is that with both of these methods, we can illustrate them taking some of the cash that they have in the bank and reinvesting it. But this is just going to be assuming that everything that's in the bank is going to be growing cash rates of return unless we indicate otherwise. The third option that we're going to view here is going to be the use cash reserve goal to manage cash levels. With the use cash reserve goal to manage cash levels, what this means is that you can specify what they will be maintaining at cash rates of returns. So for example, if we select this as our cash management method and hit save. Now when we go to the profile section, goals, we're going to see a cash reserve goal listed here. It's important to note that if you are using the use cash reserve goal to manage cash levels, that if there is no cash reserve goal entered, or if we've removed this, then everything that is currently in the bank accounts will automatically be reinvested and will be earning the portfolio return. So if we want to illustrate that we're going to be maintaining something in cash, that's when we're going to use this cash reserve goal to manage the cash levels. So for example, if I wanted to see $20,000 earning cash rates of return, we can have this start this year and end at Lorelei's end of plan. Let's have it end at both of their plans. Let's have it be jointly owned. And let's hit save. What this will do is it'll indicate that we're going to be maintaining that $20,000 in cash. Let's say, we wanted to have an increase with inflation. We can indicate an increase. Otherwise, if we say no increase, then this is going to be a stagnant $20,000. And any remaining portion of that couple $100,000 that we have in the bank is automatically going to be invested into the portfolio return. And it's going to assume that we're just going to maintain this $20,000 earning cash rates of returns. When we go to the retirement module and under cash flows, and if we go to the accounts tab specifically, this is where we can see a breakdown of the accounts and the ending balance by accounts. This is also where we can go to see a breakdown of what makes up the taxable bucket. And just to illustrate what it looks like if we indicate that cash reserve goal, as we can see, we're going to show $20,000 in the cash reserve. It's not growing because we didn't indicate that there's going to be any increase. What happens if we have no increase and we do, of course, we're having this earned cash rates of return. So let's say our cash rate of return is 1.5%. Any growth on this is going to be assumed to be automatically invested into the portfolio. So it's just going to be a flat $20,000 in cash. And one thing to note too is that if we have a large enough expense that would deplete their taxable account, so let's say they had an extremely large expense and they did deplete their brokerage account, the system will still tap into what is in the bank, that's $20,000, to fund that expense if necessary. So this cash reserve goal is only an indicator of what you want to see growing at cash rates of return. If you want to specify that dollar amount, we can either have it be growing with an inflation figure, or we can have it sectioned off and have additional cash reserve goals if needed. So this is one way to ensure that there's a certain level of cash or a certain amount of money earning cash rates of return. Like I said, with the cash reserve goal, anything that is currently in the bank accounts in the net worth section that is not $20,000 is above that amount is going to be automatically reinvested into the portfolio. But in the event where we're not using this setting, and let's say we wanted to use the treat bank account as cash option, we wanted to assume that the bank account is going to be growing naturally with cash rates of return, and we wanted to illustrate them investing cash with this setting, we do have that option. So let's say we wanted to utilize the setting to treat bank account as cash and spend the cash before taxable brokerage. If we select that and hit save, we do have the option to illustrate clients reinvesting the proceeds or reinvesting their bank account into the brokerage or the portfolio. To do so, we'd want to navigate into the retirement module. And so right now, currently, their current plan is that they have, just to recap, they currently have $630,000 in the bank with the treat bank account as cash option selected. In the current plan, this is going to be earning just the cash rates of return. So they have a fairly large amount in the bank accounts. And we're going to create a scenario, a proposal to invest some of that cash on hand into the portfolio. So we're going to go back into retirement analysis. And then here in the action items, this is where we can start to curate some proposals, and we're going to be curating that proposal of investing some of that cash on hand. And so we are going to click on the edit button at the bottom right-hand side of the screen. And here's where we can start to add a new item. So to model them pulling money from the bank and reinvesting into the brokerage bucket, the first step we're going to take is we're going to click on add new items, income, distribution. And the first thing that we're going to want to change on this card, just to make it easier, is that you can elect which type of account we are pulling from with this distribution card. So from this from account dropdown, we are going to select the bank option. And the nice thing with this particular card is that you can fully control how much is being distributed, when it's being distributed. And we can also indicate if it's going to be a full withdrawal of the entire account that's going to be distributed and reinvested, or a specific dollar amount, or even a percentage of the account balance, whether it be at the start of the year or the percentage of annual account balance if this is reoccurring. But let's say we wanted to keep it a fixed dollar amount. And let's say we wanted to show them reinvesting $430,000 of the bank into their portfolio. So we're going to enter the annual amount of $430,000. Let's also title this, that way we know this is going to be bank distribution. And let's say we want to see it occur next year. We can set the start year to 2024 and the end year to 2024. But you can, of course, have this occur after a number of years. So you can have this be occurring across multiple years or at a different point in time. If this was reoccurring, you can set an annual increase as well. And we're going to hit the save button. And so now that we've hit the save button, we're now going to illustrate them reinvesting that proceeds. We're going to show the proposed plan as a 95% probability success, and that's because we have their bank account being distributed, and it's going to be reinvested as a result of my settings. So to illustrate this on a deeper level, if we navigate to the retirement cash flows, and here under summary, this is where we can see that nice inflow outflow breakdown on a year-by-year basis of what is occurring for this client plan. Here we can see that pull from the bank account of $430,000. And then in the net flows, we're going to show a positive amount being saved into the brokerage account. We can also view this information under the account sub-tab, so similar to what we reviewed earlier. Here we can view the net cash flows. And if we click into the taxable bucket, we can show that pull coming from the bank account and the reinvestment into the taxable brokerage investment account as well. And so we can also view that growth. And back under retirement analysis, this is where we can view a nice side-by-side comparison of their proposed plan in which they reinvest those proceeds into their current portfolio versus the current plan in which they maintain that bank account of $630,000, and that's just earning cash rates of return. Another key comparison visual that we can find here is going to be under the comparison sub-tab. So here under comparisons, this is where we can see how much more the proposed plan has in ending assets. We can also view the difference in net worth, in ending net worth between the proposed plan and the current plan. And we can also view other things such as the difference in taxes paid between the two scenarios and also the assets at retirement as well. So some nice key comparison visuals can be found under the aptly named comparisons tab over here. But one thing that I want to address is right now I have a specific setting that assumes that when I have this distribution, it's being reinvested. If we navigate to the gear icon settings section, that's a result of what I have also set in the methodology tab. So under methodology, it's important to note that I do have modified cash flow base selected. What this assumes is that surplus cash flows are automatically going to be spent off each year with modified cash flow based. There is a certain nuance with the modified cash flow base is that you can fully control what is being saved. But there is another setting with modified cash flow base that's important to note, in that there's the setting to indicate whether or not you want to save automatically or spend automatically RMDs or planned distributions. So right now I have with modified cash flow based the setting to spend unsaved RMDs or distributions deselected, which means that when I have my distributions occur or RMDs, I'm assuming that they're automatically saved. But you do have the option to check this off, and this will assume that that would automatically be spent off. If we have the setting selected and have it assumed to be spending off their surplus cash flow and any RMDs or distributions, that's when we actually have another step that we want to make sure we are doing back in retirement analysis. And here under the action items, we're going to see our bank distribution. As we can see, the probability of success is 80%. That's because we are just distributing the money from the bank and we're not saving it yet. So there's just going to be one extra step that we want to make sure we're doing with this particular setup of settings. So we want to click on the edit button, add new items, savings, and then taxable savings. What we then do is we'd illustrate them capturing that $430,000 into the taxable bucket. We can have this be jointly owned, and we can have it start 2024 and end in 2024 to capture that $430,000. So we can retitle this reinvestment of bank funds. Hit save. And that's how we can capture them saving that bank amount and reinvesting it into the brokerage bucket. This is relevant if you're using, like I said, that modified cash flow based setting, and if you have the spend unsaved RMDs or distributions selected. Otherwise, it's going to assume that it's automatically reinvested with other settings. Another key setting that plays a role in when we're having a conversation about cash on hand, once again, going into the gear icon settings section, here under methodology, you can also incorporate when we're looking at the asset allocation chart that can be found under the investment module. Here under investment asset allocation, right now, this is what their current portfolio looks like. As we can see, it's a nice 58-42 split, earning a 6.9% return. This is just considering what their investments look like. But when we are having that conversation about, we're really heavily invested in cash, we've got a lot in the bank account, we do have the option to incorporate that bank account into this display particularly. So if we go back into the gear icon settings section, we can then check off this setting to include the bank accounts in the asset allocation chart and hit save. And when we go back into the investment asset allocation tab, here we're going to see the current allocation looks different. So what we just did is we included the bank accounts into the asset allocation. We're going to show a different split, and it's going to obviously be more heavily invested in cash. We have a 56% of their portfolio invested in cash. This can be a nice kind of eye-opener of potentially being too heavily invested in cash if we're trying to have that conversation of what it looks like of potentially reinvesting in the portfolio. This can be helpful for that context of being too heavily invested in cash and how that can drag down a portfolio. We can also compare it to a target allocation. So if we did want to assign their portfolio to a specific target allocation, we can also view, this is ideally what the total portfolio might want to look like. on the right-hand side as well. One thing that I want to note is that when we are including the bank account in the asset allocation chart, all that is doing is it's just simply impacting the display that we're viewing here for the current allocation chart. Their portfolio is still going to earn whatever the rate of return of what we just saw previously for that earlier split. The 6.9% would be what the total portfolio is earning. Since we have treat bank account as cash selected, the bank accounts are going to own cash rates of return. So what we're doing is we're just including that bank account into the conversation of this is how it's dragging down your portfolio potentially if we don't want to be invested in cash, or if we are trying to gravitate towards cash for any reason, you could also say we're almost there. Going back into the gear icon settings methodology section, we can then deselect it if we wanted to look at what their portfolio looks like without the bank account. Back under investment asset allocation. So here we can see it goes back to the 58-42 split. And this is what their portfolio of investments are looking like and what their portfolio return looks like as well. And this is another great question that I already see. So under the gear icon settings section, with the planning methodology right now, like I said earlier, I'm using modified cash flow based, which allows me to control exactly what's being saved. And it's going to assume that any surplus cash flow that's not indicated as being automatically saved is going to be spent off. You do have the option to utilize cash flow based. With cash flow based, this is going to assume that surplus cash flows are automatically saved into the taxable account. With this particular method, you don't have as much control over what's being saved into the taxable account, specifically because we're going to be assuming that everything is automatically saved for surplus cash flow. So in the instance in which we were doing a distribution, that would be automatically saved if we were doing cash flow based, for example. But we can see some pretty powerful visualizations back in a retirement analysis. And this can be modified if we need to illustrate them investing less of the bank account into cash. And so that's why we wanted to draw it back. Let's say we only wanted to invest $300,000, but let's say we wanted to also assign the allocation for their entire portfolio into something that's more aggressive than what we currently have for their portfolio. To do so, we'd of course draw down that bank distribution and reinvestment of the bank distribution to the $300,000 listed here. But if we wanted to assign a different asset allocation for their portfolio, we'd want to navigate to the strategy section. And then here under strategies, we'd go to asset allocation. And then from this drop down, we can select either one of the default portfolios or a custom portfolio if you have one built out. So let's say we wanted to put them into the most aggressive asset allocation. And then let's hit the refresh button to see that impact upon their property success, for example. And so that's how you can illustrate them potentially reinvesting bank proceeds and also going into a different asset allocation. And let's say that's the case, you can also once again go to the comparisons tab over here. This is where you can see a nice almost side-by-side comparison of their current path, which is not reinvesting the bank, versus our proposed plan of reinvesting some of the bank cash into the portfolio. You can view that nice invested assets comparison in this dollar figure. Another nice visualization that can assist in the conversation of, what are we saving is going to be under the savings tab as well. And we can kind of view savings over time here as well, because I see that's a nice question. So if people are trying to analyze what they're saving, including maybe this distribution, but just in general, the savings tab is going to have some nice visualizations for the conversation of what clients are saving over time. We can of course see that bank reinvestment next year, and then their general savings plan. So fantastic question over there.